Welcome to Beat the Market.
I'm Richter.
And I'm VKM. So today we're trying something new. We have a guest in today, Anna. She's an expert in real estate. And the commonality is that she uses data to make better decisions in real estate.
That's right. To track long-term trends and see how the market evolves over time.
So there's a few things I'd like to get into. One of the aspects we could discuss is how real estate differs as an asset class versus stocks and bonds. The other thing I'd like to discuss is how you got into using data analysis in your real estate decision making. And then so we'll see how it goes. Let's start with, let's start with the markets, the general view of the stocks and bonds and real estate differences. Well, I've never had real estate. Real estate was never my cup of tea. And I don't have a good reason for that, other than I thought it was hard to manage the risk of real estate, meaning the purchase size is high, so diversification is difficult. Getting in and out,
it's not liquid.
It's not liquid, and I didn't really know what the edge per se is. That being said,
the edge is a highly local one. Yeah.
And so that's one of the things I do want to discuss is, you hear cliches and all in anything, and sometimes what I found interesting is the data shows that the cliche has merit or doesn't. And so one of the cliches is real estate, everything is local, local,
yes.
or location.
That's right, both of those.
So is that, we'd like to know if,
I think that's absolutely true. Was it Buffett had a quote that, or is it Munger, that you can never know more about why he doesn't like real estate because you can never know more than about that particular block or that neighborhood than the person who's
so I'm in good company at least.
It's true, that's right.
But the thing about real estate is this, and this is my, my own, where I see maybe there's a shortcoming in my view, is that I've read something along lines, and it was some years back, so whereas if you went to every American city and ranked the 100 richest people in that city, over 50% would have made their money in real estate. So, and there's not many asset classes in the world where the bank will lend you almost all the money to buy it. So there's clearly something amiss in my construct of avoiding that asset class.
Well, I think it's how the perception of what it means to invest in real estate has evolved. Those people made money in real estate in all sorts of different ways, usually related to land value and development, or having lots of income-producing properties that they perhaps also developed, and timing when they got in. I think what's happened, though, of late is that people fancy themselves real estate investors because they're buying individual condos. And that's a very different thing. And is that, so, is your area of expertise and interest Miami Beach, Florida, Miami-Dade County, national? So I look at national trends, but I live in Miami Beach and I'm focused on what's happening in South Florida, but I look at how it all ties into the national picture. Yeah, especially also in Florida, we have so many outside buyers, so you have to see how it connects with exchange rates, other political climates, all those things. So so this is one of the things that I don't know if you know this, is that I moved into Miami in 2007, sort of loosely on the anticipation of a crisis, and thought I'd be here and there, maybe there'd be an interesting opportunity. And according to whatever analysis I do, which was based on income generation versus the asset class, I never really found something. And at the same time, though, I was telling people, because I back then would always share my view on the world, right or wrong. Back then, not anymore.
Well, I've gotten more humble in recent times. I'm realizing that my views might not be right, but I would share my view, and people would be like, yeah, whatever. Tell me more about Miami real estate. So it's definitely an asset class I think that has great interest.
Well, it gets a lot of attention. It's the branding of the city. I think in Miami, especially, real estate gets a lot of attention.
Okay, and why is that?
Oh, I think it's tied into the marketing of the city. The palm trees, the this, the that. People all associate that with the place.
It's pretty.
Real estate's pretty. That's also why it gets attention.
The credit boom did make the city beautiful.
It did, absolutely, as did the cocaine boom earlier.
Yeah, I haven't seen that Cocaine Cowboys yet. Have you? You've seen it?
Cocaine Cowboys is awesome. So
supposedly, just to give the viewers that may have not seen it, but supposedly a lot of this Miami City was built on the cocaine trade in the 80s, and the cocaine money would go in the banks,
coming out the
and then the
trade.
Banks would have
It's a great documentary. It shows all the cash that was flowing in the banks here. They had to buy cash counting machines, all these things in the banks.
So, well, I was wondering how far well, you know, say that from another video, but how far removed that world is from today's world, or is that, you know, something of a kind of a relic of the past?
I don't think that drug money is fueling it.
Or not drug money, but just that kind of like, you know, free flowing money.
No, not so much. Not so much.
So one of the things I do want to discuss, well, two things I do want to discuss is that last week I think you made a presentation to the Miami Land Use Committee,
Miami Beach,
and I want to talk about, or I want you to talk about your observations and what your analysis showed.
Okay.
But before that, I think you have a great story in how you kind of became, found your way into this world of using data analysis in real estate. And so let's talk about that a little bit. How'd that get started?
Well, that kind of started, so I moved to Miami about 5 years ago and started to learn more about the city. And one thing that's interesting about Miami is how quickly it grows. So prices are cyclical, but the city keeps growing. That's kind of a constant. We have 7 years now of consecutive airport traffic growth. Population and visitors and tourism. All those things are going. So people keep coming. I mean, if you see pictures of the skyline just 10 years ago, it's unrecognizable, let alone 20. So it's still like early days in the city's development. Very, very much so.
Oh, you mean like, so right now is still in the midst of development. There's a whole.
Oh yeah, there are prime lots downtown that are undeveloped, underdeveloped, or empty, whatever it is. Absolutely, yeah. So as much as happened, more is coming. They're price cycles, but the growth part is constant. And so anyway, I started learning about this. I thought there was great opportunity in the ongoing growth of the city. And then I started to just learn more about the industry, and I was just amazed at how little data was used in decision making. And my background is in math. And anyway, so I started charting things, graphing things, looking at stuff, and I realized that many people who've been in the industry, especially on the residential side, not to malign that sector, but that most of the offenders were there, had no idea of pricing history, nothing. I think they don't even lie, they just don't know anything. So I thought there was opportunity in that. And just for my own knowledge, I feel like I need to know about something if I talk about it. And so I started charting things, doing all this stuff, and then using that for clients, for people looking to invest, on a more specific level, showing them what data that would help them in their decisions. And just not many people do that.
So in your analysis of analyzing data, first, where did you get the data from?
Oh, all different places. So residential is particularly easy to chart because Miami has an MLS where you have all the resale data. You can slice it and dice it.
So MLS for the non
MLS is the multiple listing service. That's where residential transactions are clocked, basically. If something is sold off market, it won't be there, but the vast majority are sold on market and they're in the MLS.
And that's a national database.
Well, it's Miami specific, but yes.
You access the Miami data.
You can access it if you're registered.
I would say if someone's out there and says, "Hey, I love what Anna's doing," and they're in St. Louis.
They would have to be a member of the Miami Realtors Association or broker or something like that.
To access the Miami data.
That's right. But it is public if you are. Like many thousands of people, tens of thousands have access to this data.
But all realtors have access.
All realtors have access.
So
brokers have access.
If you're working with a realtor, you could ask them to.
Absolutely. Everybody has it, and you can export it all. Miami started getting the MLS in 2006. You can export all of it. You can slice and dice it any way you want. Price point, neighborhood, units, whatever. You can any type of data point you can do it by, and you can start charting things. And
interesting.
And you can just export the data, and you start to see clear patterns.
And so this is you never saw this being done before.
No, people will issue market reports like major brokerages will. They all paid to have them issued, but when they issue them quarterly, whatever it is, they show you year over year. And that's it. And the longest I've seen one show past 3 years for basic data. That doesn't show anything. Year over year is kind of useless from a market cycle perspective.
This is a very slow cycle.
And they don't. I mean, they show year over year pricing, but then they don't show you other stuff. They don't show you how active listing count is piling up or not piling up. Like you don't really get the information that shows you how the market is moving.
Oh, so I think one thing. This is something I think a lot of people would be interested in some of your reports that you generate. So maybe what we'll do is we'll provide a link to your website.
Yeah, the website is analytics.miami, and you can go see the reports there. Yeah.
So they can get an idea of what kind of reports you're generating. Now, so you took this data and you've come up with all kinds of conclusions.
That's right.
And one of your reports you delivered to the Miami.
Well, that was a special report. Yeah. Okay. So I had published 2 reports at the end of 2017, beginning of 2018. One was a long-term look at condo market trends in all of Miami-Dade, going back to 2007. And then one was a special report that I put together because I tracked inventory, absorption rate of inventory. And I did it for myself because this isn't anything I've seen tracked. We all know how price moves in a crash. We've seen those how condo prices, the decrease, all that stuff. But when people tell you months of inventory, that means how long it would would take for inventory to sell given the current rate of sales. And people will say, oh, there are 50 months, there's this, there's that. But you don't know how that compares to previous times. I've never seen a long-term chart of that. And so I did that. I charted out long-term from 2007 for condos in Miami-Dade, Miami Beach, all the neighborhoods, various price points. And it was really shocking what I found.
What'd you find?
There's twice as much inventory pretty much as during the last crash. At high price points, it's like an unmitigated disaster. 3 million plus, there's like 120 months of inventory in parts of Miami Beach.
120 months of inventory at the high end.
Yeah, there are no bids past 3 million. And downtown past 1 million, just not even 3, at 1 million, downtown has over 100 months.
Okay, so now this is one of the things that I mean, it's not completely unknown that there is potentially a glut of condos.
No, but it's twice as bad as last time. That's the part that was unknown.
Okay, yeah. So your discovery was that it's twice as bad.
Because I charted it's horrible.
Now, laymen like me kind of have this idea that there's a glut of inventory, but this is kind of what my confusion on how to apply the knowledge in real estate. Like in the markets, you know, we'll say that there's this information that we believe, but if the rest of the market knows it, it's you know, how valuable is that information?
Right.
In real estate, I mean, it's not the amount, the quantum might have been you know, discovered by you, but there was this kind of just, and it might have been in my layman view that there's this excess inventory. Yeah, I mean, I'm kind of aware of it. I mean, I'm not clueless as to what's going on in real estate, so I'm kind of aware of it. I knew it wasn't a good time to be a buyer, or it's not a good time to be a seller.
Neither, really.
Until prices. But that's the point. Is prices have to adjust in some way.
Right, that's right.
And if the prices aren't adjusting, then and if everybody knows
we're seeing a decrease in transaction volume steadily, which is what we are seeing.
Okay, so this gets into, so then you have this idea that there's excess inventory. You feel that it's going to be a problem.
Correct. How does this help you? You're asking. What do you?
Well, no. I mean, we'll get into that. We'll get into that. First, I want to see the quality of the info first, right? Because so, you know, getting back to this idea of how do we make decisions, right? And this is the larger one. Like everything we're doing is how to use data to make better decisions. And there's, you know, a few aspects of how you're making decisions in an uncertain world, right? And we use the data to take care of, find as much certainty as we can find. Then there's this area of uncertainty that we'll never know, which is the future. But you don't want to have areas that are uncertain that could have been found out. And that's kind of what you're, exactly. That's the area that you're covering. You want to try to paint
as much of the picture as you can.
Right, you're filling out this huge area which was uncertain, but it had no need to be uncertain.
No, it's simple.
But there will always be an area of uncertainty. Yes. And then there's the idea, and this is where, again, real estate became a problematic, and deal with residential real estate became a problematic asset class for me, is in markets, there's the idea of how do you manage behavioral biases or emotions. And in real estate, how does that work? You do all your analysis and then you go into the house and your wife wants it because the bathroom's beautiful.
That's why it's such an illiquid and not so rational. And people, you're dealing with people on a very one-to-one level. I mean, you're always dealing with people, but in this case, it's one-to-one.
And you know, and one thing I'll say, you know, as I get older, the humility part is that it's not irrational. I mean, in the sense that it's not being profit maximizing or money out. But you know, if you're saying that I place great value on my wife not complaining to me every day about it, where we live, or you place, you know, on the beach or whatever it is. I know. Correct, right. So I mean, it's fair.
No, I mean irrational when I see properties listed, residential properties listed for periods of 2-3 years, chasing the market down, and if they had just priced better 2 years prior to that, they would have sold for more.
So that's one way you could use this information.
You see that a lot. Absolutely, to price in the trend line.
Well, if you see a buildup of inventory in your price zone, you want to make sure, you want to undercut all the other things on the market. Because there are some buyers out there still. There are very few relative to the
But they're out there.
Inventory.
Things are selling, correct. Yes.
But if you can be the lowest, then you'll get that one buyer.
And you can't have your head in the sand. The market's going this way. You can't price as if it were going up. Like you're going to lose money waiting and nothing's going to happen. Then you're going to have to reprice. So that's not rational. And that happens a lot.
They want to sell anyway.
Yeah, they want to sell.
They're anchored to some.
The light is better in my apartment than that one next door. You know what I mean? Like
they're using. So this is the thing. You know, it's I don't know what the bias is, but you know.
This is a defined bias. If you have already own something, you ascribe it a higher value than if you don't own it, but you're thinking about buying it.
That's right. That's right.
So this
it was an experiment done with candy bars. People who were given candy bars, a class that was given candy bars, half the class gets a candy bar, half the class doesn't, and then you mix it up. The ones who already have it will come up with a higher average value for the candy than the ones who.
Right. So somebody will be like have some and then there's that, I don't know what the price is called, and then there's the price anchoring where they
my neighbor sold for X 6 months ago. They'll be like and then they'll have the price in their head that the one high transaction that happened in their building.
No, anchoring doesn't even need an actual transaction. Anchoring could just there have been experiments done with anchoring where you have somebody. All right, so you name a high number like randomly. You say. There are 500 jelly beans in this jar, and then you ask, or there are 12 jelly beans in this jar, and you tell some people 12, you tell some people 500, right. And then you ask them how many countries are in the world, and those who were told there were 500 jelly beans will guess a higher number.
I've heard of this phenomenon.
Yeah,
that's right.
So anchoring doesn't need anything real. So in real estate, that could just be, my neighbor listed for 10 million.
That's what happens also. That's correct. People say people listed at. It's a free country.
Never mind that it's only worth 4, but he listed for 10.
No, I know. Did you hear? Yes, this happens all the time. Yes.
Right. Our numbers are definitely high because of Miami Beach, by the way. 10 million, 4 million, but
I know, right? We're like, it's only worth 4. No, that's right.
But so these are the things that your data is able to parse through, and actually that can be actionable.
It can be. Sometimes you show someone if they can read a chart, it means something to them. Some people you can't help, but that's just how it goes. But yes.
Oh, that's the one where. Oh, so this is the other thing about markets, and this is my recent appreciation of how poker at least is helpful in these games of decision making because you get iterations at it, and for a lot of people in real estate, and especially residential real estate. They don't have a lot of experience making decisions.
No, correct. That's exactly it. It's like their only investment decision, really.
And so they're gonna make the mistakes all of us make. Yes. But I learned it on a penny stock at $2.
And that's their one-off transaction, their big transaction that they're doing it on, their biggest asset.
And it's huge.
In many cases, it's their biggest asset.
It's a huge asset. It's a relatively huge asset for most people. So that whole dynamic is
tricky. Like the whole thing's tricky. I know.
And this is the hundreds of millions of Americans have to.
Well, yeah, and then I think the conversation changed. It was the 90s or the 2000s where people thought of it as an active investment, their home. I think people didn't used to think of it that way as much.
Homes went up so much from the early 80s.
There's this expectation that you make money in your house or your condo or whatever it is, and I don't think it was always that way. And then you have these amateur conversations. People will say, oh, they bought it for, this is very common, they say, oh, they bought it for X, they sold it for Y, they made this much money. They're not telling you inflation, they're not telling you commissions, they're not telling you carry cost, any of that.
Property taxes, yeah.
And so the whole thing gets distorted.
Right.
And then the perception gets distorted. They didn't make any money, they had to take all that stuff off.
But, so one of the things, I had a discussion with a former business partner of mine with real estate. The reason I believe real estate works so well for people, one is circumstances of the last 30 years is we've had inflation. You could be levered to inflation.
Right.
And the other thing was the volatility couldn't shake you out.
Well, it stops you from being very careless with your money, if anything. It's not going to go to zero unless it's bombed or something. Right. So it's probably a safer play than just if you don't know what you're doing and you start buying stocks.
It's forced savings.
It's forced savings, which is fine. It's okay, exactly.
And you can't, and that illiquidity kind of helps.
That's right.
People.
You can't be impulsive. You can't just be like, oh, I'm getting out, or I'm buying more, or whatever. Exactly.
And maybe for married people, it's a two-person decision, so that provides a little bit of dissent and feedback for you,
which further creates the friction to the sale or the whatever, which is good in this case.
Or for a system makes a better decision. Whereas I can just
the impulse
type in my stock and be like,
haha, I got some more. No one saw that.
Nobody saw it, right?
Exactly.
And then you don't have to, you don't have to tell anybody or
exactly. Exactly. It's true. But then the most important thing in all of these things is just where you buy it in the cycle.
Okay, so that's another thing. So these cycles tend to be very long. Now, if we moved to Miami down in 1980, it would have been a fantastic time to bought, I think, right?
It might have been a bubble then.
I'm not entirely sure. Exactly.
Oh, we have to look at the data.
Yeah, that was that's right.
Yeah, Miami was like the one refuge from that nasty recession of the early 80s.
Oh, the 86, 87?
No, the early 80s.
Oh, there was the 81, 82.
Yeah.
There's a lot of money here.
And that was the cocaine money.
Yeah.
So we'll have to go to the data of that, but at some point, Miami real estate, I guess my point is...
you could have bought in the previous crash, and prices doubled in many buildings and many properties. But you had to have gotten that, you know what I mean? Like, you had to have bought when people were saying, oh, it's so awful, everything, it's going to stay low forever. Like blood on the street, the classic 90s. Thing. When people think it's really awful, that's the time to buy your...
So that's the thing, real estate, these cycles tend to be long. Now, if you miss the cycle,
Miami's not that long.
We mean the cycles are a little bit more frequent. It's not what we call a higher beta asset class.
I think it's 10 years trough to trough here. It's pretty fast.
Especially at the high end, because you have all these foreign buyers and American buyers from outside other parts of the country.
Non-locally supported.
And they treat
it. It's volatile.
They treat it as an investment.
That's right.
So this is one of the things that I wonder about the future of Miami Beach in particular, because we live here in Miami.
Actually, was how Miami's been rebranded as a destination. Like, we've lost homestead count, full-time residents. We've lost multifamily housing inventory, which is accessible to people making the median salary, and it's been replaced. The decrease in multifamily has coincided with an increase in hotel room count.
So there's a lot more hotels on the beach,
but less multifamily.
Now, okay, so. The property land's expensive, right? And to justify that expensive land, won't that lend itself to these hotels being built?
Kind of. It's land and other stuff. So Miami Beach has a few dynamics with that. One is that Miami Beach is very difficult logistically and restrictively to develop. There's a lot of stuff. Zoning is very complicated. There are all these overlay districts, all this weird stuff. Like city of Miami, Central Core, they have this great overlay. It's very simple. It's like simple districts. You know what you can build. They're being liberal and allowing, forward-looking parking concessions, all these things.
This is for property developers, residential property developers.
Miami Beach, no. Miami Beach has all these complicated overlays. It's like, if you front on this street, you can do this. But if you have 100 feet fronting there, you can do that. It's very complicated.
And is there a political reason for that?
It's because it's tied in a little bit to the preservationists, who think that we need to, come hell or high water, preserve some not so great little dumpy buildings built in the 1950s. Oops, I shouldn't say that. But
you got to preserve that Art Deco style.
It's the architectural preservation.
It's a lot of stuff like that. Not that they all, look, there's some nice buildings. The problem is that, so for instance, in North Beach, where I spoke, a lot of, what I did was I segmented out from 2017 transactions, resale and rental prices in various units, depending on the year that the building was built. So I saw what was the average sale or rental in a building, a condo or an apartment built in a building post-2001, like different segments, right? So the vast majority of inventory up there, North Beach, was built pre-1960. And half the transactions happened before that time, in buildings built before that time period. And those were built, many of them, to be small, inexpensive vacation rentals. They're studios that are 400 or 500 square feet. They have air conditioners in the walls, all those things. And the problem is that the people say, the owners don't maintain them. Well, the owners, they're getting squeezed because property taxes keep going up. Their flood insurance keeps going up because they're built below the flood level. So all these problems. But meanwhile, they're not allowed to redevelop because they're historic or they're FAR
and get higher.
Yeah. So your best use becomes hotel or it becomes luxury product.
Or so just selling it to somebody that can develop, someone who's got the wherewithal.
But it's hard to develop, so they don't sell. Like, for instance, North Beach has had, I think, there's one under construction now. In 40 years, nothing new was built. Truly. It's like what?
This complicated maze of zoning, is it something that the hotels can navigate easier because they're a corporation and a business?
They make yes, and also hotels are more profitable per square foot than a cheap rental, so you can do that. You can pay whatever you need to do, build whatever you need to build, hire the lawyers, hire the whatever, and build a hotel if the zoning allows for it. Or a luxury product, which you try to sell, but that's where the glut is. So what's happened actually is, if we look at it, for condos that sold in Miami Beach last year, 2017, that sold in buildings built post-2001, so newer buildings, the average resale price was just under $1.5 million, which means that everything new that was built, it's expensive, it's an expensive product. The median salary in Miami Beach is $51,000. So all those things were marketed explicitly to outside buyers. They can't be anything else.
Now there is a lot of, this is one of the things, there is, I would imagine, a lot of outside buyers coming because of all these baby boomers, and particularly the North, that have money, they're going to retire and come to a lower state.
So we're still heavily Latin here. It's like 60%.
Miami Beach is primarily Latin.
Yeah, absolutely.
Latin meaning from South America.
That's right.
And so the biggest buyers are South Americans.
100%, that's right. And the dollar went up. Our transaction volume drop coincides kind of nicely with the increase in dollar strength from 2012-13 also.
Okay, so meaning the foreign buyers didn't have, it was relatively expensive.
I'm sure there are many reasons, but that was one thing that happened also in that time period. So it's a volatile thing. They're not end user market, and everything new is expensive. And so my presentation that I gave was how the middle is getting squeezed. It's called, you have this like steady number of subsidized housing that the city provides, then you have all this new inventory that's expensive, and you have hotels adding. So it's like the city's becoming increasingly a destination either for tourism or for second, third home buyers. And the middle section, which is accessible to people who have normal jobs, is shrinking, while the subsidized is staying the same.
Now, is is this an example of gentrification?
No, I don't think so. I think it's stratification.
Okay.
Gentrification, that's my word for it.
Okay, so
I think gentrification, I mean, I don't know, I haven't looked at the exact
in your mind, how do you...
In my mind, gentrification is when one group of end user, one group of people living in a neighborhood is replaced by another group living in that neighborhood. What we're having is people living in a neighborhood replaced by visitors.
When everything gets more expensive, that's gentrification.
Yeah, also that too. So these people are getting displaced not by full-time residents, another pool of them, but rather by second, third homeowners and hotel count.
Oh, so this is an example of the land use is changing.
Kind of, yeah. Well, land use and just who the city is being marketed to, really. So it's not gentrification. It's like you have this low end that's staying, and everything else is high end for visitors.
Now, could part of it be driven by, one of the big industries on the beach is the hotel industry,
which is doing awesome. So talk about sectors here. The hotel industry does great here. It's a fantastic sector. People keep coming.
I saw that report, and that was fascinating.
Yeah, the hotel market here, it dips like everything, but then it comes back better. Like in 2016, I don't have 17, it was the 4th highest RevPAR market in the country. It's a great market segment. People keep coming. Airport, like Miami has, I think, the most direct international flights of any airport in the country. People keep coming, but locals are leaving.
And where the locals go?
They're going to the mainland. They're going elsewhere. I mean, where they
more affordable.
Yeah, or where they can get a similarly priced product, but one that's new. We have a product problem. So nothing that's new, especially for millennials, younger people. They have X dollars to spend. They can spend X dollars in a product that was built in 1950, which has an AC sticking out of the wall, or they can go to Midtown and get one in a cool new building with a pool on the roof.
That was one of the really interesting things I saw in the 08 and 09 crisis, was that there was these really, really nice high-end buildings that were made and priced for the luxury segment, and because of that crisis, and they couldn't sell it, they'd have to rent it out, and the rent was cheap because there was a lot of them. Yep. And so a lot of these young 20-year-olds, professionals were renting out really, really nice. So I mean, in that sense, there's this idea of one person's I don't know what one person's pain is another person's opportunity, or one person's...
It's zero sum that way, I suppose, yes.
So, I mean, I want to get to the larger point where, people that aren't so, we have viewers all around the world.
Everyone that comes to Miami, it's wonderful.
You got one thing I'd say, completely unrelated, is during that last crisis, I was wondering how things would play out, and I'm walking on the beach, and I'm like, no matter what happens, though, you see the ocean, you see the beach,
That's right.
The cycle doesn't take that away.
It's volatile, correct. But I would say it's connected to a more national or any place, that this happens everywhere. Perhaps I'm not an expert in other places as much, perhaps the length of cycle is different, but this cycle always happens.
Oh, it is throughout.
Yes, like Sam Zell talks about this, buying stuff at the bottom below replacement cost, and then that's where you make your money when you buy.
That was one of the things we talked about last week, is that in these kinds of asset classes, you have to the money's made in
that's
the
buying.
Most
important
thing. You have to be a value buyer. You can't trend trade real estate.
No. But what do you do in the mid-cycle? That's like, so if you run a business, this is my thing with real estate. If you run a business, what do you do mid-cycle, right? Because there's maybe a window of time that's a good time to buy, right, and there's a window of time that's a good time to sell, or you could argue anything above your buy price, and then depending on what you can do with your capital, it may be a good time to sell. But that aside, there's one good period to buy, and if you miss it, or you're not here, or you're not born yet, or whatever the case is, or you're in college, or whatever it may be, so you're in mid-cycle. So what do you do then?
Well, not all segments of it will perform the same. So the condo market here is in trouble. Multifamily has been doing great. I mean, people will say that yields are a bit... It's hard to get a return anywhere now, right? Like everything's
expensive in the world.
But not all things are equal. So I would say that too. Like, for instance, industrial is doing great in Miami too. There's increased demand for that if Amazon comes, because people are buying those warehouses or shopping centers for increased usage of fast delivery from online purchasing. So there's always something that has growth, and also different locations.
Right, real estate's not this monolithic thing. There's different segments, industrial, there's residential, hotel, like there's a ton of stuff.
You want to align with the growth of what's happening in the...
And you can always look at it property by property.
That's
if you're
true
looking
too.
at a multifamily apartment building, for instance, it has a real steady occupancy.
That's right.
It doesn't need a lot of
People
work.
have built fortunes that way in multifamily.
It's paying you, I don't know, 5-6%. But whatever, if you're going to hold it for 30 years, it's a good asset.
For inflation, it's fine.
And then there's also the value you can provide. Okay, so you buy things that need work. There's always things that need work.
That's right.
So that's what you can do, and you could also maybe have a management company.
That's right.
That
see where you can add
that
value,
provides service,
and like lock into where you see growth and demand, natural, like not speculative, but local growth and demand.
But when you get the
then you
prices, then you got to have your.
That's right.
Those are the big opportunities.
That's right. That's the transfer of wealth opportunity. Because it always gets better.
Sam Zell locked in some properties at a 20% yield during a late 80s, early 90s.
Well, I read that he bought some like office building in LA after while riots were basically still going on for like a third of what it cost to build 3 years before.
Just with the LA riots?
Yes, Zell bought some stuff there. It was great. He bought it for below replacement cost, and that was a great buy.
So if you're looking at the country as a whole or the world as a whole, you never have to wait too long between crises.
That's right.
There's always something in the world.
There's always a crisis somewhere.
You don't want to communicate this idea of that. No. You're hoping for a crisis.
No, but it's more like
somebody has to buy.
It's like herding behavior.
Yeah, that's true. And you're giving somebody the liquidity that wants to get out.
Without the vulture buyers, I mean, where does it stop?
Right, like what happened. Let's say recently, this disaster in Puerto Rico, or Houston. If people want to leave, there's some liquidity.
They need someone to come in there with money so they can do it.
Yeah, so it's not. It's two sides make the market. No one's forcing them to sell, and everyone's doing something with their own volition.
And patience.
And patience. So getting to this idea of decision making and using the data, is there anything else you want to add to that? Like, I guess how somebody can do it themselves in their neighborhood, where they're from?
Well, the first thing I tell people is just not to believe what your neighbors say. Not that they're lying, but I don't mean that, and it's not malicious, but people have belief systems
or wishful thinking
that are not backed up by data.
People hear
things. That's I heard. Just don't do that. Just try to do your own research. And also the big thing is year over year is just not enough. Try to get as long a picture as possible on what the cycle is, because that'll be clear.
Just look at the Case-Shiller index.
Yes, look at if anything, look at the Case-Shiller index. That's a great place to start.
For your own city.
That's right. And the long-term return. And like what did Shiller said that was whatever 100-year period, it was a 1.5% return or something
on real estate.
Oh, less.
Yeah, less.
After inflation, the long-term return on real estate, just holding it, not renting it out, is less than 1%.
That's right. Taking inflation cost carry. I know. A structural obsolescence.
There is basically zero return on real estate.
This is a residential or
residential
real structural obsolescence.
I'm telling you.
Any
land. If you just think about it, I mean, how could land appreciate on average by substantially more than the rate of inflation? I mean, it's
unless there's a change of use.
Right. The exceptions are when a city is booming, an up-and-coming city. So if you bought Chicago in 1830 or what have you, or
Central Park West, right?
Central Park West,
and then there's only one Fifth Avenue, or and if you happen to have your asset,
if you happen to hit one of those situations, of course. But on average, land itself just keeps up with inflation or slightly better. I mean, how could it do any better than the economy as a whole?
And then there's a lot of input costs to built upon, and then property taxes.
Absolutely, just buying a plot of land and hoping for gains is, you're probably going to end up negative after taxes and maintenance.
Unless you get it right, unless like you buy it, it gets upzoned, you sell it for something immediately,
and
that's where the local information comes back.
It's a very inefficient market. What I'm hearing here is that the real estate market is far less efficient than stocks. You really can get an information edge.
Oh yeah, absolutely, hugely, yeah. That's, I think, a large part of how people make money is from the local information.
Put a fine point on it. The real estate market's more inefficient than the stock, and because it's more inefficient, you can have an edge and beat the market.
Yes, look at that. I agree.
Just your negotiation skill. I mean, you bid one-on-one, engage in this zero-sum game.
That's true.
If you just hold out, if you're not like totally in love with this property and you've got to get it, if you say, all right, I've got 3-4 properties that I've got my eye on, I'm going to start putting in some low ball bids and play hardball.
Which you can do
when
in
you
this
get
market.
hit,
It's fun.
that's free. That's like free money.
Yes.
So this is one of the things that was definitely represents my lack of knowledge in real estate is that Dave Swenson, who runs the Yale Endowment,
yes,
has this model which I think is brilliant, which is stuff that doesn't have the potential to generate a lot of alpha, such as trading bonds. He just does it in-house in himself, or they do it in-house, large cap equities. But stuff that where good management has a huge edge,
right,
they outsource. So they get the very best venture capitalists.
Right.
They get the very best LBO guys, for private equity is what it's called today.
Right.
And the very best real estate managers. And I was shocked that real estate management has that ability to have generate that much alpha.
I'm not surprised.
And so to your point of that, it's inefficient negotiation.
It's going to be local knowledge. It's going to be negotiation skills.
Yeah, huge. That's a huge part.
And,
huge. That's right.
And management skills.
Yep. All those people-related things that are intangibles, really.
Yeah. Once you own it, you've got to run it like a business.
That's right. That's right.
That I was talking to a real estate guy a couple of years ago looking into something, and I was shocked at the returns, and he said that, which is that you have to look at it as kind of two things. Real estate's kind of this hybrid asset. It's an asset, but it's also is like a business. And so there's work that has to gets done to it, and work that's in it, and kind of the returns reflect this two aspects of this asset class.
Absolutely. Yeah. Agree.
So it's 7 o'clock. Which means
what
to
time
us,
is it where you are?
Which means to us that we're running out of time, and we're going to wrap it up. So, is there anything outstanding that you want that we should have talked about that we didn't, and right now?
Well, I don't know. I suppose these the themes are part of what you guys talk about of using data to make decisions. I think that's the most important thing, because oftentimes people have belief systems that are kind of like religions. So and they don't even trust the data when they see it.
So I think to all my friends that really interested in Miami real estate, because I get that question more than anything, we're gonna have the link to your website, and then they can read your reports.
Right.
And I think that'd be kind of helpful. And that's geared towards Miami, but Miami's an interesting.
It's a very interesting market.
Interesting market. And the way you're approaching it might maybe help people look at.
It applies to any market. I would say
take
absolutely.
Be more more quantitative.
The same process would apply to any market. Absolutely, it's the same metric, same process.
All right. So thanks for watching.
All right. Well, thanks everyone. Thanks for having me.
Thanks for coming.
Michael, thank you for having me. All right.
We'll see you next time.
Take care.